My name is Jake, welcome to the channel. In today's video, I want to share with you all my dividend investing rules. Now, I like to remind myself that I have these rules, especially when the market's at all-time highs. Now, it's really easy to make money in a bull market. It's very difficult and emotional in a bear market. And so I like to remind myself when things are going very well, that things will not always go well. It is inevitable that there will be market crashes and corrections in the future. It's just part of investing into the stock market. But I'm not going to sit here and say that I'm, calling the top or, that you should all go and reevaluate your strategy and your investing and all that good stuff. All I'm saying is that you should have dividend investing rules that you can follow. And if you want to be a better dividend investor, you need to have rules in place to keep you in check in both good economic times and bad economic times, because rules help you to stay disciplined and not overextend yourself. Now, I know that everyone loves to quote Warren Buffett, so that's exactly what I'm going to do. Pretend that I'm smarter than I really am because I quote Warren Buffett. So here's a quote that goes well for this concept, and that is, "Only when the tide goes out do you discover who's been swimming naked." And a way that I interpret this is investing too heavily on margin. Things are great until they aren't. And so if you're investing speculatively or you're overextending yourself when the market's at all-time highs, yeah, things are great until the tide goes out and you really see who's been swimming naked. And that's the famous quote from Warren Buffett. And speaking of quotes, like our friend Mike Tyson always says, everyone has a plan until they get punched in the face. And the market can really punch you in the face in a bear market. So what I'm saying here is, despite whether you're in good or bad economic times, it's really important that you have rules in place that you can follow. So it really doesn't matter if the market is roaring at all-time highs or if we're in a bear market, you absolutely want to have dividend investing rules in place. And speaking from experience, it is much easier to implement these rules from a position of strength and not a position of weakness when you have to learn the hard way. And so I want to help you and hopefully convince you to, whether it be this, what I'm talking about in this video, or some form of it, that you put together your own dividend investing rules that you can follow. And by having rules that you can understand and follow, it helps protect you from the unfortunate, unforeseen events, because if you don't have rules, things cannot always work out. And it not always working out, well, it could look a little like this.
Purdue breaks for second. Zadino's throw into the runner, and they got him. Oh my goodness, that's unbelievable.
Oh man. All right. So let's take a look at this. Now, these are my rules, my dividend investing rules. So the very first rule is never invest more than 5% in a single stock. Now, stocks are great until they aren't great anymore. Now, a lot of you have been hearing me talk about this for many years on my channel. And the main reason why I talk about this so much is because this is how I got burned in the past. This is how I lost a lot of money in the past, because I thought that I was like Warren Buffett and that I could pick I could beat the market and I could pick stocks better than, somebody else, right? That I could do it better than an index fund. And I quickly realized that my ego it got the better of me. And so that is why I talk so much about it. And I love seeing comments of people saying, yeah, I'm going to go 60% into NVIDIA and, 50% or 40%, whatever percent, the percent doesn't matter. And they have this massive ego, and you can just read it in the words that they're writing. And I always think to myself, you know what? I tip my hat to you, the best of luck. And the thing is, they may get lucky. If you do have more than 5%, you got 20%, 30% in a single stock, it may work out and you may feel like a genius for a while, but unless you're retiring and never going to invest again, guess what? It's like the roulette table. You throw the dice and, throw the ball on the table and you see where it lands. The game starts over Okay, so every time that you're investing, you're playing again at the roulette table. Now, it's maybe a good, maybe a bad example of what I'm trying to depict here, but the reality is that your average person, and you might think that you're above average, kudos to you if you think that, but the reality is you're probably not above average and you're probably normal. And normal people, you're better off going with an index fund or having a rule that insulates you and protects you from your own ego. And the way that I do that is to limit I don't have one single stock represent more than 5% of my overall portfolio. I mean, just think about it. All these index funds out there, they do a rebalance regularly, whether it be quarterly or annually. And what do? Every index has a rule that a single stock in many cases cannot represent more than a certain percentage of the index. And so I would just highly encourage you to put together or to understand what you're comfortable with. But for me, my investing rule number one, never invest more than 5% into a single stock. My second rule for dividend investing is do not marry your stocks. Remember that this is capitalism after all. Don't get emotional about your investments. Remember that corporations, corporate bonuses are paid out and pizza parties and layoffs are a fact of life. I reserve the right to kick my stocks to the curb just as much as they reserve the right to kick their workers to the curb. Don't marry your stocks. Don't get emotional. If something changes within the company or if something changes in your life, it's okay to sell your stocks. It's okay to change your major if your goals in life change. Rule number 3, if the facts change, I change my mind. If something changes in the business or if the company begins to lose its moat, then you can change your mind about owning the stock. The perfect example of this is with dividend cutters. If you invested into a stock because it was a dividend aristocrat and it supposedly had a great track record and a great future, well, if they cut their dividend, then yes, of course, you can change your mind and sell the stock. That is the reality. If things in your life change, in your personal life, if you get laid off from your job, or if you need to retire sooner because of an illness or a family member becoming ill, or things in your life changing, you can change your strategy. So it's very, very important to understand that not only the facts at a company can change, but the facts in your own personal life can change, and you have to be nimble and flexible and willing to, what I always like to say, roll with the punches. As life changes, as life happens, you can change your mind. Rule number 4, watch those fees. If the late Jack Bogle taught me anything, it would be to watch those fees. Don't fall trap to the illusion that high fees mean better performance. Don't put your hard-earned money in the pockets of others that are merely looking to take advantage of you. Fees can add up. If you've never done this before, go and Google an expense ratio fee calculator and play around with it. Maybe if you only have $1,000 in your portfolio or you have a couple $100, maybe it doesn't seem like a lot. But if you start to rack up a larger portfolio and as you start to look at decades and decades, well, those fees add up and they can reduce your overall performance. So keep your money in your own pockets. Don't put your hard-earned money in the pockets of others that are trying to take advantage of you and gouge you for your money. And rule number 5, remember, you're not Warren Buffett. Keep it simple. Look at investing greats like Warren Buffett for inspiration. Don't go out and blindly copy their way of investing. Don't look at some YouTuber and think that they know everything, that they have all this figured out, because they don't. They really don't. They're only showing what they want to show you when they pull up their camera, they put on their mic, and they start talking. You only see what they want you to see. So understand that you're not Warren Buffett. Don't copy other people when it comes to their investing strategies. What I always say is don't copy, but take inspiration. And don't just try to blindly copy something because you saw somebody else do it, because it worked for them. Because you're forgetting that this is personal finance, and you're forgetting the personal part about it, because it is personal and unique to you. So you have to find your way, and you have to make it work for you. But don't ever do something and say, I'm doing this because that old guy Warren Buffett did it and it worked for him. Hopefully you get value out of hearing about my dividend investing rules so that you can come up with your own personal dividend investing rules. Remember that the world of investing is not black and white. Your personal truth lies somewhere in the middle. Thank you so much for watching. I hope that you found the video helpful, and I'll see everybody in next week's video.